Hello traders, Gary Wagner here. Approximately 10:30 in Honolulu, 4:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is May the 2nd, 2014, and this is the Daily Report for gold and silver, our weekend review. And we are ending the week on a positive note as we see a nice little surge in the precious metals markets. First of all, to gold, just trading off of the highs 1306, currently trading roughly 1298 to 1300 in that area, puts it up about $14 on the day, and that's a 1% plus gain on the day. Tremendous spike in silver, up roughly 40 to 50 cents on the day, 1947. Now it is trading below 1958, but an impressive showing nonetheless, actually up about 2.5% on the day. Low 85, 1885, high 1975. More on silver at the end of the show. First to gold. We're looking at our short-term chart, 320-minute chart. This chart, of course, is in standard candlestick format. When we look at this chart, a couple of things are quite evident. Hopefully you've had a chance to view chart this, so we're going to move on from there. But when we consider the fact that there's obviously been this nice upwave, this is really the beginning of the year in which we saw the market move roughly $200, 1181 up to about 1392. We had our first corrective wave here, comes up 50%. We felt pretty solid about that. We were forecasting the market to come anywhere between 50 and 76%, so it came to our first set of parameters. As it came down, my sense was because we had made a new low, this low here is 77, and this low here I believe is 68. So we made this new low. I felt fairly comfortable entering the market from the long side. Of course, we got in roughly at 1292. However, market only cooperated with us for a little bit. We had a 71% retracement. If you recall from yesterday's show, I did a very, very quick fib retracement. And the fib retracement that I was looking at was just in this defined area. And what we were analyzing is from this low to this high, and then this market move back down, is a 76% retracement. So this is it right here, the 76% retracement. It is as much of a retracement as you can go before invalidating any kind of a model that you're working with. If it retraces more than that, it's given up all of the gains, and therefore it's not really a retracement. It is a market that is at a pivot point, going from bullish to bearish, bearish to bullish. Nonetheless, our pessimism was replaced this morning with a little light and some optimism as we saw this nice upside surge. Now, what are we looking at? Well, in terms of very, very short-term minor resistance, I believe 1310 was this high right here. I believe the high was 1306, just a couple of dollars off of that. That's going to be our first point, and then 1330, 1328, that would be our second point. And that's assuming we see this market continue and begin to build and move up higher. The second thing that we saw, which I still think could hold some weight, you have this lower low here. There's no doubt about that. But at the same time, we have this low here at 77. I call these matching lows, and we really have the potential, as I've talked about over this entire week, that we could see some sort of base forming and the marketplace itself, most importantly, finding support in this most critical area. At least that on a short-term chart. When you consider the statement that trading and technical analysis is as much of an art form as it is a science, it really pulls me in when I consider the kind of activity we've seen in the market. Elliott wave, very, very difficult to get a concrete wave count that stands out to a point where there's no other models that we can look at. There are other models. We've had this kind of a mishmash of trading activity, especially when we consider the candlestick signals. They've almost been all over the board, and this is what I'm talking about. As this market came down, right in here, we had an engulfing bullish. We didn't get confirmation, but we got confirming candle on the opposite day. That's all right. Market comes up, you get this extremely long line. This would be an engulfing bearish. This candle does engulf it, but look at how much lower this low makes. You can see you've got a series of red candles, standard candlestick chart again, but they're very, very small bodied. And then we got this Three River Morning Star right in here. And this is where our signal was derived from, was this particular point here. And the following day, we actually did get confirmation. However, we got no follow through, because then we had 1, 2, 3 days in which the market traded lower, this being the beginning of the week, the end of the week, this being Friday. And then today, of course, with this candle, we're back at 1300, you've gotten another engulfing bullish. So you're getting series of candles that are pivot indicators, key reversal indicators, and in many cases are actually confirming, but they're very, very short-lived. In other words, there's not been that defined trend that we typically want to see in a trending market. It means the market is really kind of finding its way, and it isn't trending absolutely, and if it is, it's trending in a very, very choppy and defined manner. Nonetheless, we are long, recommending that we maintain our long through the weekend. Got a couple of dollars in there. Most importantly, is the fact that the market held those lows. That's what I feel most comfortable with. Now, when we consider the range today, this candle had a tremendous range. What was this? 70 was the low, 1305 on the high. Looks like it's going to close right around 13. But we did get, first of all, a higher low and a higher high. We did find support in this particular area, and that we've closed well above it. So all in all, it seems as though we could be back in the game in terms of building a base and seeing the market move to higher grounds. We'll have to see how it unfolds, but certainly I'm more optimistic today about our current trade than I was yesterday. We have been under not extreme pressure. Market hasn't been against us that many points, hasn't really come near our stop. However, I have found, especially in a nicely trending market, that when we get on a trade that seems to bear fruit, or a lot of fruit, it tends to work from the get-go, meaning you hit these defined trends, and those are followed by consecutive up days if we're long, or consecutive down days if we're short. But here we've had this kind of development of a range right in here, and it looks as though with this engulfing bullish that we got today, this nice recovery that we're witnessing today, we could see the market unfold with higher pricing next week. At least that's what we are looking for. Now, just to give you an idea of how choppy the market's been, all I've done is I've converted our standard candlestick chart into a Japanese average chart. And I draw your attention to this most recent trading activity the last week or so. Because one thing you get with the Japanese average is the fact that it filters out a lot of the noise. So that as the market moves down, you get consecutive reds. Market moves up, you get consecutive greens. What we look for is the body size and whether or not there is a lower wick as it moves up or an upper wick as it moves down. You can see the absence of upper wicks here. The first wick is a pivot point. Absence of lower wicks here. And then we get this doji candle. Market comes down. We did get our doji candle. We got 2 days of up. But these last couple of days, and even this update, if you compare the standard candlestick chart, how that looks to this, it is because we're comparing it to the midpoint of the prior day, but you've got these small bodied candles. 3 out of the 4 days are very, very small bodied candles. Now, you tend to get this type of trading activity as the market consolidates. My only real concern is as it consolidates, you can see, for example, right here, it's been moving up, sideways, and then a spike up. Sideways and a spike up. So we are watching a market that's been coming down. Here it's counter trend, then it comes down. So is the sideways activity indicative of something before it comes down? My sense is, as I said on the last couple of charts, because we are potentially forming this base here, we have a pretty decent opportunity that we will see higher pricing. But we want to look at all of the charts and all of the data as objectively, of course, as we can. Now, I brought up a standard Japanese average chart, but this is a 3-day chart as opposed to a weekly chart or a daily chart. Each candle represents 3 days. And when we take a look at this, because it compresses the data to the degree of which it's not quite a weekly, but a lot more than a daily, we see this defined uptrend. We do see this defined trend very, very short, and really the characteristics at this point is sideways any way we want to look at it, whether it is a 3-day, a weekly, or a daily chart. But the kind of activity we saw today, as I said, I believe if we're closing in this area to 13 or above 13, of course, would be the best. I think we have a real opportunity to go to the various resistance levels. As I said, 1310, 1329 to 1333. That's where I'm currently pegging our resistance. I looked at this chart a little bit on the most current insert in Chart This, and it's an alternative count that actually makes a little bit of sense. And this is just, we're looking at our primary count, primary or major 1, major 2. This is that long major 3 and major 4th. What we want to focus on right now, of course, is whether or not this M4 is completed. That's obviously the big question, because that tells us whether we're going into M5, a major impulse, or we could have lower pricing. And as I've talked about, one of the biggest pieces of compelling technical information to me is this double bottom, and the fact that the market really held just above this 61% retracement. Realize the 61% retracement is a retracement from just below 700 to 1900, and then 61. So in the big picture, which is what I tried to talk about on the insert today, but in the big picture, it makes a very logical argument, and there is technical backing to say that, yeah, we should have completed this cycle at this point. The fact of the matter is that this market is absolutely, always has been, always will be, fundamentally driven. However, the fundamentals right now have a geopolitical edge, as opposed to the majority of the edge being an economically based scenario in which we're looking at economies, markets, inflation, things like that. Whenever we get instability and geopolitical uncertainty, as we have in Ukraine, it is the type of wild card that will send the metal skirmishing to the upside if there are some challenges. And of course, you'll see the market erode that premium very, very quickly if there's a perception that they're moving towards a peaceful resolution of the crisis over there. So you're going to get wild gyrations in the market. You're going to get the big swings. But most importantly, I don't think we've done any long-term technical damage in this market. We had the most dynamic, greatest single rally ever in gold when we consider the kind of move that it had, a $1,200 move. When you have that kind of a sizable move, a 61% retracement is not unheard of. We had a double bottom. This particular cycle took almost 4 years. You've got the end of really 2008 all the way up to 2011. Then from 2011 down to 2014, you got 3 years. These are long blocks of time. And so if in fact we are going to enter this M5, we're talking about a process that will unfold over the next 2 to 3 years. This is not an overnight scenario. This is why I call it the big picture. So trying to pick a bottom after the market has been coming down for 3 years is going to be challenging at best. It's going to be tricky at best. But if it was that easy, everyone would do it and everyone would make money off of it, and that's not the case. Now, we are doing well. We're in our 5th year of consecutive profits, and knock on wood, we'll continue to do that. We'll work hard at that as always. But these markets are tricky at best, there's no doubt. So where do we stand right now? We want to maintain our long position at 92. We have basic scenarios, models, and goals that we have outlined throughout the last couple of weeks. And the big question is, do we want to take a stab at silver? You know that I've been very, very lackluster, or just not that bullish on silver, because it hasn't been acting in a way that I believe warrants our attention to the long side. However, today's action is a real nice spike, but here's the caveat. When we look at silver, pulled up our daily chart in silver, beginning of the year, that's where we draw our attention. And this is when gold really started to spike up. As a matter of fact, let's go ahead and put up a gold chart in here so we can look at the two kind of side by side. I haven't sized them, but I think we can extract the information that I'm looking for. Here's what I'm talking about. Beginning of 2014, gold's trading 1180. Absolutely positively, we see this market in a defined rally. That rally moves us $200. It takes us from January, all of February, into March to do that. Now, let's look at silver at the same time, right in here. As gold is moving up, silver continues to trade in this band. We don't see any sort of definition. And then right at the beginning of February, in other words, gold is right here. It's already made a nice clip up and is in its second leg. We get a very, very quick and rapid spike in silver. And that spike, of course, takes you to about March. And then when gold comes down, and gold comes down in terms of where it tests below 50, but above 61, silver comes down and gives back pretty much everything and then some of what it gained. In other words, it went below where it started. And so that to me doesn't really beckon any kind of bullish sentiment. Now, at best, what I'm thinking is we might see some sort of a spike again as we saw here in February. But when we look at this market and compare it to gold, even with the trickiness of trading the gold market, we're certainly not seeing this kind of compressed trading range, spikes, and then giving it back in the same amount of time. We're getting much more defined trends, and traders, to me, that's what we really want, are those defined trends. We'll look at silver again on Monday, but as I said, one day doesn't make a market, and as I did recommend, I think that we're better off putting our precious metals trading or investing equity right now into gold. I just think the return over time will warrant it and will be a much better return than we would get in silver. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. Have a great weekend. Bye-bye.